My name is, as Richard said, Fredrik Dackheden, and I am responsible for the transaction department at Croisette Real Estate Partner. I am located down in Malmö, so it's nice to be up in the capital for once. The agenda, we're going to talk a little bit about the macroeconomy, talking a little bit about the debt market and focusing on Sweden, going a bit into the investment market, and then finishing off with the projections of what we think about yields, rents, and the different segments, and then summarizing everything up in the end. So hopefully this is going to take about 20 minutes. Starting off with the GDP growth within the Nordics, we can see that Sweden in 2018 had about 2.3% in GDP growth. Denmark slightly lower. Finland had the best GDP growth last year. Norway had fairly low growth rate in comparison to the rest of the region, and the Eurozone as a whole was around 2%. Sweden is forecasted to have a decrease or a slowdown in the GDP growth going forward up until 2023. The same goes for Denmark, or basically the same. If we go to Finland, they will have the biggest fall in GDP growth going forward. Quite heavy drop in growth, whereas Norway is the country that's projected to have the best GDP growth in the coming 4 to 5 years. And the Eurozone is also going to have a slight decrease in growth. And as you can see, Finland has gone from the highest level of growth to perhaps like medium in the coming 4 to 5 years, and Norway comes from a fairly low level of 1.4 up to 2.1 in the upcoming years. Still fairly good growth, but a bit slow down from what we've seen in the recent years. And in terms of inflation, this is the numbers for 2018, and we have most of the countries are just below the 2% mark. Norway had a fairly high inflation in 2018 in comparison to the rest of the countries. And these dots are the representation of the forecasted inflation rates going forward. So we have some sort of stabilized level around 2%, 1.8 up to 2% in the upcoming years. So fairly good growth. Inflation rates are projected to be quite stable around the 2% mark. And if we're going to have a look at the interest rates, and this is a graph of the 3-month interest rates in Sweden, the Stibor, Europe is the Euribor, the Norwegian and the Danish 3-month rents as well. We can see that we have a fairly sharp drop from 2008, 2009 during the financial crisis, and then we had pretty much leveled out or slightly lowering the interest rates over time. Have a look at the last 1.5 years, and you can see that the Norwegian interest rates have never been actually under the 0 mark. All other interest rates have been below, but the Norwegian ones is a bit higher than the rest. And if we look at the short-term trend, the Norwegian 3-month rate is slightly increasing, or has been increasing over the last 1.5 years. The same thing actually goes for the Swedish short-term trend. But if we have a look at the European mid-term trend or medium long-term trend, it is still horizontal or quite flat. So we project that the interest rates will be quite low in a foreseeable future. I'm going to talk a little bit about the different currencies in the Nordics. Finland uses the euro, obviously, and Denmark is using the Danish krona, but the Danish krona is quite closely pegged to the euro, so we see them as basically the same in this context. This is a graph of the Swedish krona in comparison to the euro since 2010. And the same one for the Norwegian krona, also from 2010 up until today. We can see that both the Swedish krona and the Norwegian krona was at its highest. It's a bit in reverse, this graph, so I hope you understand how it's supposed to be interpreted. Somewhere in 2012, 2013. And since then, the trend is a quite significant decrease in value in the Swedish krona in comparison to the euro. And it's basically the same for the Norwegian krona. The difference is that the Swedish krona has had a fairly less volatile journey from 2013 up until today, whereas the Norwegian krona has been quite, well, it's been more volatile, more ups and downs. So this is basically a sign of Sweden and Norway being comparatively cheap in relation to the euro. With that said, that does not mean that the Swedish real estates are per se cheaper, but the currency effect makes it a bit more cheap than the euro. If we focus a bit on the debt market, this is solely focusing on the Swedish market. This is a graph of the different alternatives of finance. We have the cost and the risk on the horizontal axle. And formerly, bank loans were basically the only option for financing real estate, or at least the majority of real estate was financed by ordinary bank loans. What we've seen in Scandinavia, or in Sweden in particular, is they're moving up the scale to all the other financing options. And this is actually a graph showing the emitted bonds in listed Swedish real estate companies since 2010. And as you can see, the emitted bonds volume were basically nothing in 2010, and it has risen exponentially up until 2018, up on around just under 120 billion Swedish krona. So this is a perfect example of how the Swedish real estate companies nowadays can diversify their debt portfolio in comparison to what they could have done or could do 10, 15 years ago. So it's been, as you can see, more frequent that they use bonds as a means of finance. And it also means that the real estate companies are not that dependent upon one single or several banks deciding on if this is a good deal or not. Because if you have the bond side or you have the preference share side, you can always do deals in a better way. You're not dependent on the banks in that sense. So good diversification. And this is a graph showing the loan-to-value ratios on also the Swedish listed property companies from 2004 up until today. And we have an average of about 65% in 2004, and now we are somewhere just above 50%, or between 50 and 55%. And during this period we had an average of about 56 or 57. So below average during the last 15 years. So we have decreasing LTV ratios, which in itself is good, but that is partly due to quite significant increased real estate values. But what we see is a quite good example of the Swedish real estate companies not taking on new debt, whereas at the same time as the values go up. So they don't use the overvalue in the portfolios, but they keep the debt level at a quite reasonable level. And this means that the Swedish listed real estate companies are generally quite well prepared for a potential downturn in the market. So this is what we see as a fairly good example of, well, we're quite well prepared, so to speak. This is a quite hefty graph. This is the total transaction volume for the Nordics in 2018. Roughly about 44 billion euros. And the inner ring represents the total volume of the 4 different countries. And the outer ring depicts the split between domestic and international capital in the respective markets. So this one is the The Swedish stake of it is about 35% of the total transaction volume in Scandinavia or in the Nordics, about 15.5 billion euros. A slight decrease in transaction volume from 2017, but still at a fairly high and good level. If we go further to Denmark, about 22% of the total volume, a quite good increase from 2017 by about 10%. Finland has had the highest decrease. The market share here is about 21%, and for Norway it's an increase of about 12% from last year, and also about just about 20% of the total transaction volume in the Nordics. What is quite significant in the outer ring here is that you see in Norway the vast majority of the transaction volume stems from domestic investors. Sweden has about 70 or just about 70% domestic. In Denmark, about 50%, and in Finland it's only about 30-35%. So Finland and Denmark are quite international markets, if you would say, in comparison to especially Norway. And what about the transaction volume for this year? We project that the transaction volume will decrease by about 10% in comparison to last year. This is still a quite good and high, healthy number, but a slight decrease from last year. And what about the yields, rents, and the different segments? Here we have the different countries, and we are focusing on the capital cities of each country, and we are focusing on office, retail, which is in this case high street, logistics, and residential. And if we take a look at the yields, we see that the yield compression has actually occurred, what we think, in Sweden or in Stockholm. I don't think that we will see significant drops in yields in any segment going forward. It's basically the same in Copenhagen, except that retail is taking a bit of a hit, whereas logistics is, they still have a bit more to compress the yields before hitting rock bottom, so to speak. And the residential yields are also predicted to be stable, or they're leveled out. The same thing goes for Finland and also for Norway. So this could be perhaps a scary scenario where we don't see yields dropping, but on the other hand we do see increased rents in most segments, not in the retail segments where we see both in Stockholm but in particular in outside the country we see decreased retail rents, especially in the regional capital or regional cities in Sweden. It's the same thing in Copenhagen. You see retail rents are going down, logistics rents are going up, and residential rents are also going up. And I forgot to mention this, the office rents in Stockholm have been increasing quite significantly for the last couple of years, but we believe that since the vacancy rates are basically nothing or none, we still see a demand supersedes the supply, so that's what we expect for the office market in Stockholm. We don't see that in Copenhagen though, because there are that many new developments going on, and there's not much rental growth in Copenhagen as we see it. We continue to Finland. It's basically the same scenario as we see in Sweden. And if we go to Norway, they are also projected to have increased rents in the office segment, in the logistics segment, and also in the residential segment. What is interesting here in the logistics segment is that both Sweden and Denmark are basically hubs from Europe and spreading out with all the goods going out into the rest of the Nordics. And both Finland and Norway are basically end stations from goods flowing from the west. Finland obviously has a lot of transports going to Russia and Asia as well. So yields are leveling out, and we see increasing rents in most segments, but the worst segment that we see is the retail segment. So to summarize this, in the macroeconomy, we can see a decreasing GDP growth, except for Norway. We see stabilizing inflation rates around 1.8–2%. Interest rates are showing early signs of slow increase, but the medium-term trend is still flat, horizontal. And the Swedish krona and the Norwegian krona are comparatively cheap in comparison to the euro at the moment. So the outlook, as we see it, is neutral. It could be better, but it definitely could be worse as well. So a neutral outlook for the macroeconomy. If we have a look at the debt market, and as I said earlier, this is focusing solely on Sweden, it's generally quite easy to get finance and capital today. Generally, the access is quite good. The LTVs are leveling out around 50–55%. We see multiple options for financing real estate deals today. Bonds, preference shares, etc. And we also think that the real estate companies are quite well prepared for a potential downturn in the market. So the outlook for the debt markets, as we see it, is quite positive. And if we go to the investment market, we see that there is still a very high demand for real estate across most segments, and especially logistics. We've seen a really high or significant yield compression within that segment for the last year and a half. Falling demand for retail, both from tenants and from investors. The transactions volumes are still at a fairly high level. This perhaps could be called something like normalized, and slightly lower than in recent years, but the outlook for the investment market is still positive as we see it. If we go to yields, rents and segments, we see that yields are leveling out across the Nordics, basically in all segments. Rents are expected to increase, except in the retail segment where we see falling rents. And finally, the logistics is expected to outperform, and the retail segment is expected to underperform the rest of the real estate segments. So the outlook here is neutral. So 2 positives and 2 neutral. So fairly good, I would say.